For the last few weeks, I've been calling the all-time high pretty much within a few handles on this YouTube channel and in the Discord server for free, and today I'm going to use a similar concept and the big figure once again, plus the daily chart and the economic calendar to predict the coming price action, and there's a spoiler alert. So this week, we've got no news on Monday, so you want to avoid the opening range. You can trade the new week open if you are experienced, because there is a lot of sentiment generated over this weekend with geopolitical stuff, so the new week open will probably be at least 150 handles, maybe more. Um, there's just war stuff with Iran, USA, Israel, blah blah blah. So there can be some sentiment. I don't know where it's going to open. It could open lower, it could open higher. I don't know. Nobody actually knows. But it does create some nice volatility at the Sunday open. So if you're more experienced, then you can trade that with low leverage. Just be very very cautious and sensible. I don't recommend anyone actually does it unless like you're very experienced. Notice Monday, so you avoid the opening range. Notice Monday doesn't mean you have to avoid the London session or the pre-market session. It just means that between 9:30 and 10 a.m., when the retail crowd is, getting involved, they really want to get into the marketplace and just dogpile on whatever they have in their mind over what happened on the weekend. So if there was a bullish shift in sentiment because of something that happened in a war or something, then they all want to go long, meaning that the opening range, 9:30 a.m. till 10 a.m., aka the first 30 minutes of trading in the New York session after the stock indices open. They want to just dogpile into the market. So you want to avoid those first 30 minutes, wait for 10 a.m. or the 9:50 macro, and then get involved in the marketplace. CPI is on Tuesday, meaning that this is going to be an expansion day, which in our weekly profile tells us, okay, if the majority of our movement is going to happen on Tuesday, then Monday, because consolidations lead to expansions, and before expansions or consolidations, it means that Monday is going to be less of a volatile day. Why? Because Friday was an extremely large range day. Monday is the only day in between a large range day and what we know is going to become a large range day because it's CPI. CPI, meaning that CPI is going to be large range. Friday was already large range. Monday has to be smaller range. We haven't had much of a TGIF on Friday, so this Monday we can get some TGIF, aka retracement. It could be a down close candle. It could trade all the way down into this inefficient, into this wick, and then use the upper half of that to keep going higher and treat it like an immediate rebalance. I'm not 100% sure, but I know that Monday will most likely not be the day where we meet our distribution expectations or our big figure target. Wednesday, let me continue on Tuesday. You don't trade until after CPI because the morning of CPI is always low probability. It's it's just going to give you a low win rate. So wait until CPI is released. Sometimes you can trade like 15 minutes after CPI, but I always recommend waiting for the New York AM session. New York PM is generally a bit of a dud on the CPI day because all the stuff happens early morning. Wednesday is a high probability day. It's PPI. The morning of PPI can be kind of hit or miss. If the price action looks good, I engage. If it looks bad, then I don't. But after PPI is released, it's always a good day. Thursday, always, well, not always a good day, but with core retail sales at 8:30, it's always a good day. And then if we don't see if we do see our weekly targets met, then we can look for TGIF. But because it's all-time highs, we won't look for TGIF by default unless we have exceptional circumstances like what we're seeing currently in the chart. And then that's why I predict that Monday will probably not be the day that has a big blast up. It'll probably be more of a consolidation slash retracement day. Here to zoom in a little bit more on the daily chart, we've got the previous day wick from Thursday. I want to see the upper half of this stayed above, so no bodies beyond this level. Really, I don't think even a wick should come in here and linger. It should just, if it does go in here, just immediately pop back out. However, there's stuff on the 4-hour and the 1-hour chart that would make me think that we probably won't even need this wick. But if we do, it's fine. It doesn't invalidate anything. It's just that I don't think we'll return to it. But if it does, it doesn't invalidate the bias. I don't think we'll go beyond this level here because this is institutional for entry drill. It goes slightly into the Fair Value gap. It's had a big pop higher. I talked about this on Friday. So I don't believe we'll go back down to this Fair Value gap. We should just use whatever's inefficient on the lower time frame, aka the 4-hour and the 1-hour, to continue going higher. Here we're looking at the 4-hour chart, and as you can see there are these two Fair Value gaps. Now I said on the daily chart, this is our institutional for entry drill. I don't believe we will trade down into this, making this, in my eyes, a long-term low. So that's a long-term low. And I do not believe until we've hit 30,000, we should ever touch this level. It should not be touched at all until 30,000. Now, we have these two fair value gaps here, which are above the the equilibrium of the, the consequent encroachment of the daily chart wick that we just looked at. And inefficiencies can always be traded into. However, I would like to see one of these remain a breakaway gap. It doesn't need to, but it's always good. If we can leave the lower fair value gap as a breakaway gap, I think we'll hit 30,000 within the first 2 or 3 days of the week. If we don't, and Monday trades that into this, then I think it'll be like Thursday, maybe Friday. So it's just a strength analysis. It's not anything that would invalidate anything. It can trade slightly below this fair value gap to use the upper half of the daily chart's wick. I don't believe it will need to do that, but it can. This is the high of the daily chart's wick. The only thing that's significant about this is that it can be touched and immediately rejected from to form as an immediate rebalance on the daily chart, so that's something to keep an eye on. In my opinion, though, I don't believe any of that is super important, as long as you keep in mind that we can retrace on Monday, maybe even go a little bit deeper on Tuesday, but really we should keep popping higher and higher and higher. In my opinion, Monday, although you can trade it, I wouldn't trade it because it's the only day that I can see this week that would go against my overall bias. My overall bias is bullish. I want to see us trade higher, but Monday could easily go against that because it's, again, as I said earlier, the day between a large range Friday and a large range CPI, so it can retrace or consolidate. I'm not going to take anything for like a New York AM trade. The only thing that I would take is a little cookie cutter in the pre-market, a little cookie cutter in London, something like that. Not anything, for more than 30 minutes really. Okay, now we are on the hourly chart, and I've left those 4-hour PD arrays up intentionally so you can see the difference in formation of the two. So on the hourly chart, we can see that this 4-hour fair value gap was created mainly from this 1-hour candle that just really quickly popped up. This was the New York AM Open, and then we've got the rest of that day gives us this 4-hour candle. It's kind of a grind higher, not anything perfect, but it does go higher, and it does create a fair value gap. Now, I would love to see this traded into and just rejected from, and then leave this one open. It's the larger one. It would just create a lot of strength and pretty easily take us toward the 30,000 big figure level. However, is that the more likely scenario? Probably not. It's allowed to go all the way down here, and it will probably be more likely to trade into this one. Now, I'm not taking anything to the sell side. I never take any sell trades in all-time highs unless it's a very, very small cookie cutter. But I don't trade anything on the downside acting on an actual bias because it doesn't need to take this fair value gap. I do believe, though, that it has a high chance of going into this, but that's kind of irrelevant to my bias because I'm not going to trade it anyways. The only thing I'm interested in is watching which fair value gap does it use. Does it use this one and then go higher? Great, then I'll trade the move up. If it goes into this one and goes higher, that's great, I'll trade the move up. What I'm not doing is trading the move down in an all-time high market. That's just asking to get your head chopped clean off your block. So please don't do that. I'm now going to give you some logic on why we should ideally not trade toward the mitigation block. It is a draw, but it's not what I want to see tapped. If it does tap it, it doesn't invalidate it because it can touch the mitigation block because it's a mitigation block. However, I'll explain the logic now. This mitigation block is a low, a high, and then a higher low. So in between the high and then the higher low, there are a bunch of large fund orders that are not trading with a stop loss. Anyone who's a retail trader, if they're in any sell here, they would have got stopped out already. But anyone who's a larger fund, you can see them in a sell here. They can get offside too. They can be wrong, and they can have a lot of drawdown at this point because it's gone very much against them, like really far against what their position would be. So there's not going to be a lot because there's not really a lot of selling in the Nasdaq right now. No one who's got a lot of money is going to be selling on an indices that's so rapidly bullish, especially in such an event-driven world right now. They want to move their money into event-driven markets that are going to be easier to time, like commodities. There are still going to be some orders in here that are active, so sell positions are in drawdown right now without a hard stop loss. Me and you, we have a stop loss, but they don't. So this mitigation block, the purpose of a mitigation block is to allow anyone who's in a sell position in this fund, in this area, price goes down into it to allow them out of their position at like a break even, and then it's free to go higher again. But we can use this as a drawn liquidity normally. However, we are in an all-time high market environment right now, meaning it doesn't need to touch relatively equal lows, it doesn't need to take out external range liquidity, it doesn't need to touch mitigation blocks. It can just go near, and that's enough. Now let me explain to you why I don't think it should touch this at all. Because A, we've got this inefficiency up here, so that's a drawn in of itself. I believe it will touch this inefficiency because of the mitigation block, but I don't think it will touch the mitigation block itself because A, it's all-time highs, and B, there's not a lot of people in here that are selling. It's a significant leg, yes, but there's not going to be a huge amount of people, sorry, not people, large funds that have any orders here because most people are not going to be bearish or selling the Nasdaq in this kind of environment, not anyone with large pockets. So it is a mitigation block. Algorithmically, it is there as a drawn liquidity to the downside, and it will facilitate a retracement, in my opinion, on Monday or Tuesday, or Monday and Tuesday, before again rallying. I don't believe it will touch it because anyone who's in this sell position, there's only a few, but say their position is like this. They don't have a stop loss to pretend that doesn't exist. They don't need price to come all the way down and touch their break even point, which would be like the mitigation block or anything in that mitigation block leg. As in, price doesn't need to go all the way down and get them out at the break even price or slight profit or only slight loss. It can get them out just for a little bit less than they are already losing. So here, say hypothetically, at this point, large funds are 1 million in drawdown, just hypothetically. Just pretend for a moment that's how it is. Obviously they're not, they can mean way more, but pretend it's a million. At this point here, how much drawdown would they be in now? 400,000, 300,000, 200,000, whatever. So it's not about getting them out of their position at break even because it's in an all-time high market environment, and it cannot go super deep in an all-time high market, take out a long-term low, and then keep going higher. If we go beyond this mitigation block, the only thing we really have to stop it is the mitigation leg, and there's nothing else that's super significant because it's all low resistance liquidity. So that's why I don't believe we should touch the mitigation block at all. We should just stay within the fair value gap. But it is the mitigation block that's facilitating the retracement because it gets large funds out of their smaller drawdown. They can close their position in less of a loss than they have up here. If we now go to the 15-minute chart, we have bull flag traders. So this is another reason to essentially take people out of their trades. That's the mitigation block, that's large funds. This is retail traders because this is accumulating above an old high. So right here, there's price movement above an old high in the way a retail trader, well, we're all retail traders, but a retail concept trader will see as a bull flag. So they'd be looking to buy. And now notice that from this bull flag, we haven't really had a very large spike higher. So if anyone is in a bull flag trade right now, bull flags can work in an all-time high market because it's very one-directional, but if you're right at the tip like this, they generally don't. Anyone who's in this little bull flag trade, they're going to get stopped out. And where is their stop loss? Right here. Oh, sorry, right here. Right there. So I believe the market, I can't make a prediction on the new week open. I'm sorry. If it opens up higher, then that's not valid, what I'm about to say. But if it doesn't open up higher, and it opens up around this level, I believe at Sunday it'll just make a quick run down to this low, and then I would remain neutral until the Monday is already done. So that's another reason it should go lower, take out these losses, stop losses, and then potentially go into the hourly fair value gap. But remember that there are the 4-hour fair value gaps, so you have to balance what you're looking at on the hourly chart and the 4-hour chart. It can use this hourly fair value gap, or it can use the 4-hour fair value gap. If it uses this and leaves this one open, it should just be a really quick run, first 3 days of the week into 30,000. If it doesn't leave this one open, then it should be the symmetrical move on the measuring gap, which is 29,800. Right here, 29,812, but just call it 29,800. It's also a big figure. That would be a full symmetrical move on what we are using for our measuring gap. So, thank you for watching. Hopefully this weekly outlook was insightful and educational. If it helped, then consider subscribing and leaving a like on the video. It's free, you can always change your mind, and you'll be notified for the next week's Weekly Outlook. Thank you for watching.